All right, today we're doing a deep dive on what you could call a moment of catalysis, really, in the Midwest. We've got a specific stack of sources all focused on the Indianapolis real estate market, and they're analyzing the fallout from a very recent, very critical financial decision.
Right. And that decision came from the Federal Open Market Committee, the FOMC, on December 10th, 2025. They announced a 0.25% cut to the federal funds rate. Now, that sounds small, but it has sent immediate ripples through central Indiana, especially in housing and commercial real estate.
Exactly, and that's where this idea of the Cara Conde effect comes in, which is what our sources are calling it. We're trying to understand how one advisor's, 2 decades of market mastery can translate this big macroeconomic event,
Yeah.
this quarter-point cut, into actual real-world opportunities for buyers and sellers.
The mission here is all about precision. We're not talking about broad national trends. We're looking at the specific strategy you would need to capitalize on this exact moment in central Indiana, whether you're a luxury buyer, a family, or, a pretty sophisticated commercial investor.
Okay, so let's start with the cornerstone of all this. The figure at the center, Cara Conde. Her career path is pretty unique. She didn't just jump into sales. She started as an investor, building a multi-million-dollar personal portfolio before getting her license back in 2002. So 20-plus years of deep market experience.
And what's fascinating here is her background.
Right, the academic side.
Yeah, the academic side. She has a graduate degree in computer science from Oxford University. And that's not just a trivia point. It explains why her approach is so different from the norm.
So how does computer science actually help a real estate client? What's the connection?
It creates a tech-first mindset. So for a residential listing, you're not just getting photos. You're getting cinematic drone tours, advanced virtual staging, using tech to tell a story and boost a home's value. But on the commercial side, that's where it becomes critical. She's using GIS, geographic information systems, for site selection.
Okay, so she's not just looking at a standard zoning map. What does GIS-driven selection actually show a client?
It allows for predictive analysis. It's about seeing the future, in a way. She's layering massive data sets, traffic flows, demographic shifts, utility maps, you name it. So instead of just seeing where a retail center might go, she's finding these prime spots for, say, industrial or multifamily that are poised for huge returns in 3 to 5 years. It's an information advantage.
And that technical skill seems to be paired with some serious negotiation credentials. The sources call out some specific certifications.
Oh, absolutely. She's a certified negotiation expert, a CNE.
Right.
That signals she's trained in advanced negotiation tactics, which is obviously a huge asset. And maybe even more importantly, she's a commercial syndication expert.
Let's pause there for a second. For anyone new to real estate investing, what is a commercial syndication expert actually doing?
Syndication is basically about pooling money. You bring a group of investors together to buy a huge asset that one person couldn't afford on their own. Think a big apartment building or an industrial park. Being an expert means she knows how to structure those deals to protect the investors and, maximize their returns. It's about the financial architecture, not just finding the building.
And her area of operation is, well, it's basically the entire economic heart of the state. Avon, Carmel, Fishers, Indy, Noblesville, Geist, Zionsville, Westfield, Brownsburg, Plainfield, Whitestown.
Right. It shows her strategies are built to work across all these different submarkets, from the high-end luxury in Geist to the booming industrial corridors out in Plainfield.
So this is what I find really interesting, the dual mastery. How can one person be an expert in both the emotional, lifestyle-driven world of luxury homes and at the same time be running the hard numbers on a complex commercial deal?
Based on the source Q&A, the core skills are the same, but the focus shifts completely. For luxury residential, it's all about the story, the narrative.
Selling the dream, right.
Exactly. But for commercial, it is pure performance. It's all numbers, timing, scale. The spreadsheet has to work, period.
And what's the bridge between the two, the common thread?
The sources call it obsessive preparation and fierce advocacy. She just applies that same intense, data-driven approach to both. And her move into commercial with SVN Northern Commercial was a natural step. Her successful luxury clients were business owners who needed that same rigor for their investment portfolios.
And that partnership with SVN Northern Commercial, that's a key detail in the sources. What's the big advantage for a client with the SVN network?
It really comes down to one thing: access. SVN has this shared fee platform. It basically incentivizes every other SVN advisor in the entire country to bring her their best deals.
So it's like a national network of scouts finding opportunities for her.
Precisely. It means her clients are seeing deals, especially off-market deals, that nobody else in central Indiana even knows about yet.
It's an inventory multiplier.
A huge one, especially for those larger industrial or multifamily deals where speed and access are everything.
So looking ahead to 2026, where is this dual focus pointing for growth?
The analysis shows two clear tracks. For luxury living, it's still Geist and Carmel, the gold standard. But the explosive commercial growth is all along the logistics corridors, specifically Avon, Plainfield, and Whitestown. They are seeing just massive demand for distribution, for manufacturing, and for the multifamily housing needed to support all those jobs. It's all happening along I-65 and I-70.
Okay, here's where we connect the dots. The macro event meets the micro market. That December 10th Fed rate cut, a quarter point. 25 basis points. It sounds like almost nothing. How much does that really change the math for an average buyer in Indy?
Well, the mechanism is really powerful.
Yeah.
So the FOMC cut the federal funds rate to a range of 4.25 to 4.50%.
Yeah.
That's the rate banks charge each other. Now, the Fed doesn't set mortgage rates directly.
Right, but it sends a signal.
It sends a huge signal. It tells the market that inflation fears are easing. And because 30-year mortgage rates are tied to the 10-year Treasury bond, that signal almost immediately pushes rates down.
So the signal is what gets passed on to the consumer.
Exactly. And historically, a quarter-point Fed cut leads to a drop of about 0.15 to 0.30% in mortgage rates within a week or two. So we were hovering around, say, 6.65% before the cut. The projection now is that by mid-January 2026, rates will settle somewhere between 6.35 and 6.50%.
Okay, so let's put that into real dollars for you. How does that quarter point really affect a typical home purchase in Indianapolis?
Let's use the median home price in the Indy Metro, which is around $320,000. On a, let's say, a $350,000 loan, that drop from 6.65 to about 6.40% saves you roughly $145 every single month.
$145.
A month. That's over $1,700 a year, guaranteed back in your pocket.
Is that monthly saving the real driver here, or is it more of a psychological thing, the buying power?
It's the buying power that creates the rush. That's the psychological trigger. The sources say that little rate drop instantly gives a typical household earning around $100K an extra $25,000 to $35,000 in buying power. So suddenly, that home that was just out of reach is now a real possibility. The search parameters fundamentally change overnight.
Okay, that covers the demand side. But what about supply? With this new flood of activity, is Indy at risk of a price crash like we've seen in some other markets?
No. According to this analysis, absolutely not. The prediction for 2026 is for steady, stable growth. The fundamentals in Indianapolis are just too strong. You have the Eli Lilly expansion. You have positive net migration. People are still moving to central Indiana. And there are still supply gaps. There just aren't enough houses in certain price ranges.
So prices are expected to keep climbing. The sources say 4 to 6% gains are expected in 2026. This cut just changed the feeling in the market.
It flipped the switch from wait and see to go. It signaled that the hyper-aggressive rate hikes were over.
So for someone listening right now looking to make a move in this new Goldilocks environment, what's the playbook? Let's start with buyers.
The absolute #1 thing is to get your financing locked in. I mean, secure a full, underwritten pre-approval today. Lenders are getting swamped because of this rush of activity. You want to be able to act like a cash buyer the second you find a house you love.
Makes sense. What about creative financing? Is there anything specific buyers should be asking about right now?
Yes, you have to be asking about 2-1 or 3-2-1 buy-downs. This is a huge strategy. A buy-down is where the seller, or often a builder, pays a lump sum at closing to temporarily lower your interest rate for the first few years.
Walk me through the math on a 2-1 buy down. How does that work?
Sure. So let's say your final mortgage rate is 6.5%. With the 2-1 buy down for the entire first year, you'd pay at a rate of 4.5%. In the second year, you'd pay at 5.5%. And then from the third year on, it just reverts to the permanent 6.5% rate.
That's a massive help in those first couple of years. Why would a seller do that?
Because it's a huge incentive for the buyer, but it often costs the seller less than a big flat price reduction. It makes the home more affordable upfront, helping the buyer qualify and feel more comfortable with the payment.
And where should buyers be looking? The brand new listings.
No, actually.
Yeah.
The advice is to pounce on listings that have been on the market for 30 days or more. Those owners are now extra motivated. The market just shifted under their feet. And this new wave of buyers gives you incredible leverage to negotiate hard on a property that's been sitting.
Smart. Okay, let's flip it. What about sellers? How do they ride this new wave of buyer energy?
Sellers have to change their calendar. The mindset needs to be, January and February are the new spring market. You've got low inventory, which is typical for winter, combined with all these newly motivated buyers. It's a recipe for multiple offers if you move fast.
But just listing it isn't enough, right? The sources say you have to invest to stand out.
Absolutely.
Yeah.
The margin for error is gone if you want top dollar. This means investing in high-end marketing. The sources are very clear on this. Cinematic drone tours, professional twilight photography, these are the things that create a flood of early interest and get you the best price.
And what's the real-world result of that kind of marketing push?
It just crushes the timeline. It slashes your days on market. While an average home might sit for a month, the best marketed homes are still going, pending in under 10 days, sometimes even faster.
And pricing. With buyers suddenly having an extra $30,000 in their pocket, how should a seller adjust?
You price smart. You can aim a little higher than you would have before the cut. That extra buying power means the buyer can absorb a slightly higher list price without feeling stretched. The cut essentially gave a little boost to what sellers can realistically get.
And you can see this happening in real time. The data we saw showed that showing requests in places like Carmel, Westfield, Zionsville, they spiked 30 to 50% almost immediately after the announcement.
The market didn't wait. And while statewide inventory is around 3.8 months, which sounds balanced, the truth is that the best properties, the ones that are well located and marketed professionally, they're still gone in under 2 weeks. This cut just poured fuel on that fire.
So if we bring this all together, that quarter point didn't just tweak the interest rate. It was a fundamental psychological shift for the market. It moved everyone from a state of hesitation to pursuit.
It's a confidence play. The Fed signaled they're done hiking and are willing to ease back. That brings confidence back to everyone, from a first-time home buyer to a major developer looking at an industrial park in Plainfield. It validates the whole central Indiana growth story.
So let's leave our listener with one final thought here. The Fed is signaling maybe one, maybe two more small cuts in 2026. That's it. Which raises a really important question for you to think about. Is the immediate guaranteed benefit of locking in a rate in this 6.3 to 6.5% window right now worth more than the risk of waiting for a maybe smaller cut later on?
Especially when you factor in that steady 4 to 6% price appreciation we talked about. The real cost of waiting might not be in the interest rate you get. It might be in the price of the house itself. You might save a fraction on the rate in 6 months, but the house could cost you $15,000 more. And that's the calculation you need to be making right now.